Hey guys, what is up? It's Nick back here again with another NIO video. In this video, I want to go over everything NIO Financial. I'm finding a lot of people are blindly hyping this company on the internet without actually delving into all of their financials, the ins and outs, their convertible bonds, their debt financing, and the revenue. So I wanted to make a video going over all of this, laying it out all on the table to help you formulate a more educated and informative choice when choosing whether or not to buy this stock. Time and time again, I've seen this company outperform people's expectations and stick it to the short sellers, and I want to highlight why this is, what they are planning to do, and where their financials are heading. If you haven't already, hit that subscribe button. I do a ton of videos like this, going over everything you need to know how to succeed on the stock market, especially in the electric vehicle, tech stock, and growth stock spheres. While you're at it, if you could absolutely decimate that like button, I would really appreciate it. These videos take quite a bit of time and effort to put together, so it would really mean a lot to me and help spread the video further. Anyways, we have a lot to get to, so let's get right into it. Alright, I want to start off by laying out some groundwork of what's really happening here on a macro scale. Why do companies dilute their shares? And why is NIO continually diluting their shares? Isn't that just terrible for investors? Well, let me explain. Companies perform share dilutions by issuing additional shares, which dilutes or decreases the value of the pre-existing shares out on the market. A suitable analogy is when the Fed prints more money, inflation increases, and the value of each pre-existing dollar out on the market is decreased. This is why the value of money has been steadily decreasing over time. Dilution can occur for a number of reasons, but let's focus here on NIO's specific case. NIO is performing share dilutions to essentially gain capital to spend on research and development, global expansion, and to, well, build new products. You do need money to make things, and NIO makes things. They have performed many share dilutions, as all growth companies do, and it is inevitable that they will perform more share dilutions and probably sooner than you think. Now, although whenever a company issues out more shares, the value of the pre-existing shares decrease. However, it is important to realize that the company is doing this for a reason. They're doing it to grow and to expand. And regardless of how many shares a company has, if it never attempts to grow, then all the existing shares, regardless of how diluted or not they were, will become worthless if the company goes bankrupt. So we do want to sacrifice some value for growth. NIO has plans to rapidly expand into the European markets next year and to North America in the coming years. This will take money to do, but it is a very essential play for the company to perform, and I am more than willing to take the hit to the shares to ensure proper growth and expansion. Now, although this devaluing of shares is taking place, there is a small caveat that makes these share dilutions much more stomachable for investors. However, we need a little background to understand. NIO ADR is the American holding company of NIO China. You can think of these as the two counterparts of NIO. And this is important to note. NIO ADR sold roughly 24.1% of the company to NIO China in October 2019 when they were literally on the verge of bankruptcy. This was essentially a last-ditch effort to save the company, to generate some short-term liquidity, and to keep the ship afloat, as at the time NIO virtually had no cash or cash equivalents. NIO China is the Chinese counterpart, which is actually owned by the Chinese government and local authorities based in Hefei Province, China. In this deal that was made between the two subsets, NIO ADR is legally obliged to transfer $600 million USD to NIO China through a series of tranches. A tranche, in layman's terms, is essentially just a portion of a payment. NIO has thus far paid out two pre-existing tranches back to NIO China, therefore essentially buying back the company from them, injecting value into pre-existing shareholder shares. Two tranches or payments have occurred of $182 million each, totaling $364 million of payment. Therefore, there's still $236 million to be paid back to the Chinese government. So as we are losing value due to share dilution, due to NIO issuing more shares out onto the market, we are at the same time gaining some value back through the series of buybacks from NIO China. It's important to understand that when you purchase a share of NIO stock, you are not exposing yourself to anything under the NIO China title, yet are solely exposed to NIO ADR's stake in the company. Therefore, any buybacks of NIO China essentially adds value to your shares. Therefore, a buyback of the company from China is good news to investors. This is a very aggressive buyback plan, as they are purchasing stake through tranches before even reaching profitability. They could have potentially waited until they were at a secure place financially, however, leap in Bin, NIO's CEO and founder, and NIO ADR management are essentially betting on the company and betting on themselves. Buying back the company very early on shows that management believes there is probable intense upside quickly approaching, and they want to be exposed to these potential profits as soon as possible, whether or not they are currently financially stable. Even going back to the last tranche, we have seen that this played out very well for NIO ADR and investors. Although this is risky, it has been and could continue to play out very well for Bin, NIO ADR, and investors. Part of this buyback has helped NIO ADR shares to increase dramatically in the past couple of weeks and months. So will NIO ADR purchase back the entire 24.1% stake that the Hefei government held? In short, the answer is probably not, and let's think about this for a bit. It may be actually beneficial for NIO in the long run. As we saw in the late months of 2019, the Chinese government had greatly helped NIO survive, overcome adversity, and thrive within the market. The Chinese government has offered subsidy programs that work to include NIO, and I'm not a conspiracy guy, but it is really nice that the new subsidy program excludes luxury electric vehicles, which NIOs are. However, if the luxury electric vehicle has a removable battery, all rules are just seemingly off the table and the subsidy is applied. This is fantastic news for NIO, as their vehicles are applicable to the government electric vehicle subsidy programs, while their main competitor Tesla is excluded from these subsidy programs due to not actually having a removable battery. You can see that there may be advantages to having partners in high places, such as the Chinese government, that are also invested and interested in the success of NIO. Alright, let's discuss the further dilutions that are probable to occur. There can be up to 11% further dilution on the way for NIO shares in the coming weeks and months. This is summated through Bin, the Hefei government, and an investor company called Tencent's convertible bonds. If we've learned one thing from reoccurring share dilutions, it's this. Upon announcement of the share dilution, there is quite a substantial dip in share price, immediately followed by a substantial gain in the following weeks. These short-term dips are absolutely wondrous little time frames to purchase up additional shares at essentially a sale price. Short-term investors typically profit take and run for the doors on these dip days. However, if you are a long-term investor, which I am, my strategy at these points is not to sell, but to buy additional shares, keeping my average share price as low as physically possible for massive long-term gains in the company. If you believe in the long-term success of this company, you should not be too frazzled about these early year share dilutions. This company is still young. Many growth companies perform these share dilutions quite frequently in the early years to gain capital in a rapid manner, to expand and grow in an exponential fashion, to gain a foothold within the market. This is exactly what NIO is doing. They are aware that the only way to survive in this current market is to rapidly expand and to steal competitors' market share away. This does typically result in a very volatile stock, which NIO is. However, if you can stomach the short-term volatility, you will hopefully be rewarded far down the line. There are also 70 million additional shares that can be converted by 2024, which would further dilute pre-existing shares by 5%. With the earlier 11% share dilution we discussed, this would amount to 16% of further dilution that could occur in the coming months or quarters. Now, is this reason for concern? For me personally, like I mentioned before, it actually offers windows to buy instead of reasons to sell. If you are investing in a growth company, you need to be well aware this is all part of the deal, and it is very much common practice. Because the share dilution is occurring simultaneously to the buyback from NIO China, the share dilution is somewhat mitigated, as we as NIO ADR investors are receiving value while simultaneously losing value. It's quite a peculiar situation, but this just means that shares are not being devalued as much as one would think. So I wouldn't be surprised to see in the coming weeks or months some more of the share dilution occurring, as NIO is very eager to own back more stake from NIO China. For me personally, am I buying now? Well, the short answer is no. We've seen in past months that as NIO releases delivery numbers, something counterintuitive starts to happen and sellers actually run for the doors after great results have been released. We've actually seen this in the past few months. So ideally, I'm gonna wait until the 1st or 2nd or 3rd of October when they release these delivery numbers and hopefully buy on the reoccurring dips that have occurred. I have a nice position in this company. I'm holding for the long term, so even if we don't see a substantial dip, I will buy additional shares, as I do see intense upside to this company in the coming years, if not decades. I'm here for the long run. I love NIO. I love everything about this company. I love the aggressive expansion they are doing right now, working to get into the European market and steal that market share away from Tesla. I could see these two companies being neck and neck for quite some time in the future, and I am so excited to see what happens. Anyways, guys, I have some really interesting videos in the pipeline, so make sure to hit that subscribe button, smash that like for the YouTube algorithm. I would really appreciate it. Just a quick one today to keep you guys all updated. NIO to the moon. Happy trading, everyone. Thanks so much for watching. I really do appreciate it. Cheers.